So, just to give a brief introduction about me. So, I'm Sarjon, actually working for the Central Bank of Sri Lanka in the Bank Supervision Department. And I have been with Central Bank for last 14 years, for 15 years now in the Bank Supervision Department. And I'm a regular lecturer in IBSL and also at CBS, Center for Banking Studies, which is the training center of the central bank. And I hope I've done so many lectures on this Basel III framework. So any of you have attended my lectures on Basel III before this session? Anyone? Oh, this is the first time. For the bankers, it's a very hot topic, and there are so many programs conducted by both IBSL and also by CBS on Basel III. So only thing is, for the last, since 2016, there was no changes to the Basel framework introduced by the central bank. So the presentation I'm going to make here today is basically the same thing. So that's why I wanted to know whether there are any of the students who have attended my class previously. Anyway, it doesn't matter, but just for my information. So no one is answering. So I hope that this is the first time you are going to hear about the Basel III framework, which is introduced by the central bank. So what I'll do is I'll switch this video screen to the PowerPoint presentation. And in between, we'll try to switch again to the camera because sometime I may need to use the board here. And the other thing is to just tell me whether you can see what I'm writing in the board clearly, right? Can you all see what I've written clearly? For me, it's showing the up.
Yeah, that one is clear.
What about your view is upside down or it's viewing correctly?
No, it's okay. Yeah, capital okay.
Okay,
Capital,
capital. So it's not upside down, no?
Yeah. No.
Okay, okay, thank you. So I'm going to switch these to presentation slides. Hope everyone can see this clearly. So the today's session is about the Basel III capital framework of Central Bank of Sri Lanka. Actually, you would have heard that Basel is a place where the Bank for International Settlement is situated. So the Bank for International Settlement is an organization which provide guidelines for central banks all over the world. Now, like our central bank give directions and guidelines to banks in Sri Lanka, the Bank for International Settlement, they provide guidelines for central banks in all over the world so that the central banks are required to implement those guidelines in their respective countries. So the central banks in different countries, they follow this guideline, they do necessary modification to suit the local requirement and publish their framework. So this Basel 3 or Basel 1, Basel 2 or Basel 3, whatever it is, it's mainly focused on the capital adequacy framework for the country and for the banks. But Basel actually, they come up with a lot of guidelines on different aspects. So there are guidelines on corporate governance, guidelines on liquidity, guidelines on leverage, capital adequacy, and so many things, related party transactions. So this is actually like a central bank to the central banks. So they issue guidelines. Based on that, we do some modification because every country is different, every financial systems are different. So we do some modifications and publish our framework to this country. So I hope you all are working in a bank or maybe in a financial institution. So not like other financial institution like leasing companies or finance companies or any other financial institution. For banks, this Basel III is an important framework, right? So before introducing the Basel III, initially BIS started with Basel I framework. So the objective is to keep adequate amount of capital to absorb any losses. So we know in a banking business, there are so many risks we need to face. So I can list about 20 different type of banking business risk that every bank or most of the bank need to face. So whenever there are risks, there are losses. So bank may end up with loss-making transactions or loss-making business. So whatever the loss, you can't charge that loss to the customer or the deposit holder. Bank need to absorb that. So in order to absorb those losses, bank should have adequate amount of capital so that we can write off the losses. So whatever the Basel framework, maybe Basel 1, 2 or Basel 3, the objective of the framework is to have adequate amount of capital to write off losses coming from your banking risk or business risk. That is the concept behind this Basel capital framework. So then you might think why there are so many versions of Basel capital accord. So they come up with Basel 1, then after some time they issued a revised version called Basel 2, and again after some time they came up with another accord or revised accord Basel 3, and now actually they are working on another revised version, maybe Basel 4, or it's still not named, but there is a revision to Basel 3. So people might think that why we need so many revisions of this accord, because the objective is same. You keep certain amount of capital to absorb losses. That is the objective. Objective never changed. But the methodology of computing that adequate amount of capital has been changing. So there should be a valid reason for that. Okay. So anyone, do you know what is the reason behind moving to Basel 2 from Basel 1? So what are the main weaknesses in Basel 1 compared to Basel 2? Anyone? What are the main weaknesses in Basel 1 compared to Basel 2? Oh, why we need Basel 2 over Basel 1? You need to talk, huh? Because this is not like face-to-face lecturing. These are video based lecturing, and I can't keep on talking. So interaction is important. Even today morning, I had a class from 10:30 to 12:30, and this is 1:30 to 5:30. So it's very difficult. So morning session, I managed to managed to get people talk. So I expect the same from you also. Just tell me, what could be the reason, or what are the deficiencies in Basel 1 over Basel 2? So if you are shy of talking, what you can do is you can send a message. So we need some kind of interaction. So you can type a message chat. So on the top you get a chat window. You can type the message and send so that I can explain to others. Okay, so nobody is answering. No idea. Okay, Hasalak said he has no idea what are the weaknesses. That's fine. So because we are here to learn, so no issue. So before then, let me put it in this way. Before going into the difference between Basel 1 and Basel 2, let me ask. Now, I said for a banking business, there are so many risks you need to face. If you say for example, the risks are coming from where? You take your balance sheet, and we know in a balance sheet there are assets, there are liabilities, and there are equities. Now, which component create a risk, banking risk? Is it the assets, liabilities, or capital? Risks are coming from which side of your balance sheet? So it comes from asset side.
Assets.
Yeah, very good.
Assets.
Amma, very good. So the risk for a banking business comes from your assets in the balance sheet. Okay. So let me write down a small or summarized version of balance sheet of a bank. So before that, can you tell me what is the first item you will see in a balance sheet? What is the first item? So first item you will see is cash balance, right? So in a bank balance sheet, these are assets, first item is cash. Can you see this? So whatever I'm writing in the board, can you all see that? Otherwise, it's no point of writing.
Can see.
Can see, right. Thank you. So the first item is cash. Then we have investments. So it may be your trading investments or AFS investments, available for sale investment. Or previously you might have some HTM, held to maturity investments, right? So cash, investment, and then the major part comes loans and advances, then fixed assets. So these are the main component in a balance sheet, right? So cash, investments, loans and advances, and fixed assets. Okay. So we'll take an example. Say you have cash balance of 10 million, investments another 10 million, loans and advances 100 million, fixed assets 10 million. So this is for simplicity. So what is your total assets in your balance sheet? 130 million. So you have a balance sheet of 130 million where you have cash 10, investment 10 million, loans 100 million, and fixed assets 10 million. So again, the purpose is same. We are going to keep some capital to cover up whatever the risk coming from this balance sheet. So the Basel I, their approach is, their methodology is to risk weight your balance sheet, to risk weight. They give you what are the risk weights, and you apply that risk weight to your balance sheet and find out what is your risk-weighted assets, right? The Basel I said, if it's the cash, there's no risk. You have cash in hand, no risk, right? Of course, there are risks. There is a risk, but people might, take that money out, but there is no credit risk. Okay, there's no credit risk. So if there's no risk, you are not required to keep capital. So therefore, they said for cash the risk weight is 0, right? So risk weight. So the risk weight is given by the central bank. According to Basel I, risk weight is 0. And for all other assets, they said, the framework say you have to risk weight at 100%. So all other assets, risk weight at 100%. Okay. So by risk weighting the balance sheet, you will find what is the risk weighted assets. Okay. So we'll get the risk weighted assets. So what is the amount of risk-weighted assets for cash in this example? What is the risk-weighted asset for cash? So you have a cash balance of 10 million and the given risk weight is 0. Therefore, risk-weighted asset is 0. Right? So risk-weighted asset is 0. And investment, you have 10 million, risk weight is 100, therefore risk-weighted asset is 10. Similarly, for loans and advances, 100, fixed assets, 100. So now, what is your total risk-weighted assets? 120. Okay, 120. Then the framework says you have a risky assets worth 120 according to this example. For this 120 risky assets, you need to keep certain amount of capital. So we know the minimum capital is, we'll take for example 10%. So 10% you need to keep. So this is your regulatory minimum capital, for example. This is not the ratio, but only example. Okay. So you need to compute what is your capital, right? Because we are comparing the risk-weighted assets with your capital. Now again, tell me, what are the components of capital you can find in a bank balance sheet? So what are the components of capital you can find in a balance sheet? Component of capital? What are the components of capital we can find in a bank balance sheet? We have equity. I put common equity. So we have ordinary share capital. In the Basel term, we called it common equity. Then we have retained earnings. We have retained earnings, last year profit was distributed to the shareholders. Then there could be some reserves. Reserves, right? So these form a bank's capital, okay? And these are equity capital. We know in a bank, the capital may come from two ways. Either it can be equity capital or a debt capital. Now, debt capital, for example, is a debenture is a debt capital. So bank may have debt capital also in addition to equity capital. We'll say our bank, they have a equity capital of 10 million, equity capital of 10 million, and debenture worth, say, another 10 million. Another 10 million. So the bank's total capital, they have 20 million. So the framework says you need to compute your capital adequacy ratio by comparing your risk-weighted assets 120 with your total capital 20. Okay. So the formula says capital adequacy ratio equals your capital divided by risk-weighted assets into 100. Okay. So capital adequacy ratio is capital divided by risk-weighted assets into 100. So whatever the percentage you are getting here should be more than your minimum requirement, 10%. Okay. Say, for example, you are getting an answer of 12% here, then you have adequate capital to cover your risk. You have adequate capital to cover your risk. So this concept is same whether it's Basel 1, 2, or 3, right? The methodology is same. But the problem with Basel 1 is we are risk weighting all the assets at 100%. Okay? So except cash, all other assets are risk weighted at 100%. So is it true that in a bank, all your loans will bring same risk? All your investment will bring same risk? Is that true? No. Yeah. Hasalaka said no. Because you might give a loan to a prime company, say a AAA rated company like John Keels. So what is the chance of defaulting them or them? Very less, because a John Keels may not default whatever the loan they have taken. But you might give a loan to a different person, say a small hotel. So the chances of default are more. And you invest in treasury bill, the risk is less. Invest in stock market, the risk is more. So depending on the type of business, it could be investment or lending business, the risk is different. So risk weighting at 100% is not rational, right? It's not rational. Then this is, you are considering only the default risk, right? But we know in a bank, there are so many risks. It's not only credit risk, there's market risk, operational risk, credit concentration risk, liquidity risk, reputation risk. There are so many risks, right? But here you are keeping capital only for the credit risk or default risk. And that is not enough. Okay. So this is the main weakness in Basel 1. They say bank should risk weight all the asset at 100%, which is not rational because risk differ from customer to customer. And they want the bank to keep capital only for credit risk. That also not correct, right? So they brought Basel II framework. Okay. So Basel II framework says you need to risk weight your assets according to the probability of default or probability of risk. So cash, again zero. Investment, if it's in the trading book, there's no credit risk. Because trading book subject to market risk, no credit risk. Okay. So we'll say again, cash zero risk, cash zero. Investment, I'm going to break up. Say 5 million in trading, 5 million in trading. Okay, 5 million in trading. Therefore, no credit risk, but this is subject to market risk. So no credit risk. And the balance is HTM, that is subject to market risk or credit risk. And again, this investment is in treasury bill. So no default risk. The government we think that government will not default. So again, 0. Loans and advances, again, there could be some loan to triple A company, some loan to double B minus company, or maybe be in between. So if it's a triple A loan, you risk rate at 20%, not at 100%. If it's double B minus, you risk rate at 100%, because for a double D loan, the risk is more compared to triple A loan. So fixed assets, you risk rate at 100%. Okay. Now, what is your risk-weighted assets? So cash, 0. This 5 million, 0. This 5 million treasury bill, again 0. No risk. Say triple A. So you have 100 triple A rated loans, for example. So it's only 20%. So this is 20. And fixed assets, 10. So now, what is your risk weight? So your risk-weighted assets are only 30. So your balance sheet asset is 130. Your risk-weighted asset or risky assets are only 30. So the losses come from 30. So then you compare your risk assets with your capital. Okay. Compare your risk assets with your capital and compute the percentage. Then it should be more than the minimum. But the Basel II did not stop at default risk. It went beyond that, and this Basel II framework, I will discuss later, has 3 pillars. So pillar 1 says bank need to keep capital for default risk, market risk, and operational risk. And pillar 2 says bank need to keep capital for any other loss or any other risk. Could be liquidity risk, could be strategic risk, could be concentration risk, anything. So Basel II basically covers all type of risk in a bank. And it requires bank to keep capital for all type of risk. Right? So that is the big improvement in Basel II compared to Basel I. The one, they put the risk weight in a rational way, depending on the probability of default. Number 2, they they're required to keep capital for all type of risk, not only default risk, not only market risk, not only operational risk. So under pillar 2, they cover all other risks. So technically, all the risks are covered by Basel II. Okay. So this is a more comprehensive framework. So you risk-weighted your assets rationally, and you keep capital for all risk in your bank. So it sounds like, sounds good, like a comprehensive framework. So then why Basel III? Again, problem, right? Now, anybody, can you tell me what is the difference between Basel II and Basel III? So now we know what is the reason for improvement in Basel I. Now, why we need improvement in Basel II? Why the Basel III came in? Any idea? Oh, nobody's talking. Okay. So Basel, I'll go ahead. Basel II, they corrected the loophole on asset side, but there was some problem on the capital side. Now in capital, I said it could be equity capital or debt capital. Debentures are debt capital, right? So Basel II did not change anything here on the capital side. They changed only on the asset side. on risk weights and coverage of risk, but they never touched on the capital side. Again, they have a problem because you can meet this whatever the minimum requirement with your debt capital, right? That's what happened up to 2008. We know in 2008 there was a global financial crisis. The main reason for that crisis is bank had capital adequacy, right? They had enough capital to cover their risk, but that capital came from debt capital, not from the equity capital. So they covered the minimum ratio with the debt capital, which is again a debt loan. You need to pay back your debenture holder. So it's not the owner's capital. Therefore, when a crisis happened, bank did not have adequate equity capital to cover loss. So we can't cover loss with the debentures. So it's a debt, right? So the Basel III came in, and Basel III did not change anything here. So the asset side, risk weight and risk parameter, coverage of assets or risk all remain same like Basel II. The Basel III mainly focused on the capital side. They said bank need to have more equity capital. You can't have debt capital and meet your capital requirement. You have to have equity capital, more and more equity capital. Then you need to prepare for crisis. You have to have some buffer. So capital is fine, but capital is not enough. You have to have equity capital and you have to have some buffer. So they introduced two different buffers, counter-cyclical buffer and capital conservation buffer and a counter-cyclical buffer. Then they said, okay, not all banks are same in size. So there are large banks, there are global banks, there are small banks. So all banks can't keep same capital, like same risk weight in Basel 1. Now they say you can't keep same capital for all banks. If it's a large bank, you have to have more buffer. So they introduced something called systemically important banks, or DSIB buffer, or GSIB buffer. So systemically important mean it could be important bank to the domestic system, or it could be important to the global system. So if it's a globally important bank, you need to keep certain buffer. If you are domestically important bank, you need to keep certain buffer. So they introduced a systemic buffer. It could be a GSIB buffer, global bank, or it could be a DSIB buffer for domestic bank, right? Then they said having capital will not solve the problem, right? Now you have capital, you have buffer, but it will not solve your day-to-day problem. So day-to-day problem come from liquidity issue. So if there's liquidity constraint, liquidity shortage, then it will lead to the failure, ultimate failure. Therefore, we need to sort out liquidity problem. So they introduced some liquidity standard. We know LCR, liquidity coverage ratio, and the net stable funding ratio, NSFR, are coming from Basel III. Then they also said there should be a limit on leverage. So we know you can create money, you can leverage your balance sheet, right? You might have 10 million capital, but you check your balance sheet, your bank's balance sheet. You might have a 10 million capital, but your asset size is 100 billion. So you can leverage on your capital. So then they said, and again, that is one reason for 2008 financial crisis. Therefore, they said the leverage should be controlled, right? You can't keep on leveraging. So they brought some leverage standard. Okay. So the Basel III is that risk weighting is similar to Basel II. So that's what we will learn today. Capital side, they improved. They wanted to have more equity capital, less debt capital, and some buffers. Then not only capital, bank need to have strong liquidity and also limited leverage. Okay, so that is the total framework. So now I think I gave a introduction about these three framework. We'll move to the presentation on Basel III. Right? So Basel III. Now we know what is Basel III. It's mainly focusing on owner's capital and capital buffers. Then the risk weight side remains same as Basel II. And there are leverage and liquidity standard that we will not cover today because this is a capital framework only. Right? So Basel III, I've already explained. Well, we have already three framework, and the fourth one is in the pipeline. And Basel I is considered only credit risk and a part of market risk. Basel II is a three-pillar approach, where under pillar 1 you need to keep capital for credit, market, and operation. Under pillar 2 you need to keep capital for all other risks, and pillar 3 is about disclosure. Then Basel III focused on quality of capital. You need to have more equity quality capital, not the amount of capital. And they focused on liquidity and leverage. So we'll go into capital adequacy requirement. And for Sri Lanka, the minimum capital adequacy requirements are this. You have to have a common equity tier 1 of 4.5%. And with buffers, it goes to 8.5%. And with the tier 2 capital, the minimum capital ratio for a large bank, for a DC bank, it is 14%, right? So in Sri Lanka, we have identified 4 banks in our system as DC, domestically important bank. So those 4 banks, they should have a minimum capital of 14%. For other banks, it's 12.5. So how do you differentiate between a big bank and a small bank, between a DSIB and a non-DSIB? So it's based on assets, right? So previously our framework was only to rely on asset size. So if your assets is more than 500 billion, you are a DSIB. Your asset is less than 500 billion, you are a non-DSIB. But last year we revised that framework because it's not only the assets determine the risk or the bigness in the system. There are so many other factors. Actually, the Basel has given 5 different factors to determine a DSIB. So we implemented that framework, right? And now we don't compare only the asset size. Asset is one of the criteria, but we'll check all 5 criteria, and there's a scoring system. Based on that, we decide who are the DSIB, who are non-DSIB. So according to the latest framework, we have only 4 banks. Previously, based on asset size, we had 6 banks. Now 2 banks left out from the large bank category, from the DSIB category, because they have a big asset size, but they are not they are not critical in terms of other criteria like interconnections and complexity of business model. So there are other 4 criteria. So depending on that, 2 banks which were in DSIB bucket, now they left out of DSIB bucket. At the moment, we have only 4 DSIB banks. If it's a DSIB bank, your minimum, you have to have more than 14% capital adequacy ratio. And if you are a non-DSIB, you should have more than 12.5% capital adequacy ratio. Okay, but I just want to tell you another thing. Now, due to this COVID-19 impact, we gave some relaxation to banks. So now we permitted banks to draw down CCB, capital conservation buffer, right? this 2.5 you can draw down. So in that case, your minimum ratio go down to below 14% or below 12.5%, but it's an option. If a bank want to draw down, they can reduce this 2.5 CCB. They can reduce. If they are reducing here, their minimum ratio go down. Otherwise, still remain as same, but it's a temporary measure. After the COVID impact is over, we'll take out that. So basically, this is what you need to know. For a DC bank, 14%. For a non-DC bank, 12.5%. So then we'll see how to compute your capital component for Basel III computation, right? On the Basel III, the capital is divided into three. One is the common equity tier 1 capital. So we'll say set 1 capital, common equity tier 1 capital, then tier 2 capital, common equity tier 1 capital, then tier 1 capital, and tier 2 capital. So those are the three components in the capital computation. Common equity tier 1 or set 1 capital, tier 1 capital, tier 2 capital. So all three together forms your total capital, right? So we'll see what are the common equity tier 1 capital. So we know stated capital or the ordinary share capital is part of your set 1 capital. And reserve fund, your bank might have reserve funds, and the latest audited figure is part of your capital, set 1 capital. Published retained earnings, again part 1 or part of your tier 1 capital, set 1 capital. Retained profit in the sense that you earn profit previously, distribute part of it to the shareholders dividend, and the balance you retain, right? So if that is a plus figure, so it's part of your capital. If it's a negative figure, minus figure, you need to deduct from your set 1 capital. Then, now banks need to prepare accounts on IFRS 9 based, right? IFRS 9 standard. So according to the standard, there's one account called other comprehensive income. So if you are familiar with IFRS, you know this, right? Other comprehensive income. Now, whatever the income in the OCI account, you can take 60% of it as your set 1 capital. But there are some conditions. So it's limited to maximum 10% of set 1 capital. And if there's any losses, you need to deduct immediately, right? Right. So when you deduct losses, it's not 60%. You need to deduct 100% loss. All the loss need to be deducted immediately. If you have a income in your OCI, then you are permitted to take 60%, subject to maximum of 10% of set 1, right? And this is very difficult because this I'm just explaining. But if it's a physical class, I could have done an example. I do like that. So we'll give some computation and explain in the board. But since it's an online class, I can't do that. And so I'm just keep on explaining. So if you don't understand, you can ask me. You can just stop me and ask any question. Otherwise, I hope that you understood and I'll go on, right? So OCI 60% is part of your capital, set 1 capital. Then general and other reserves, the last audited reserve you can take, but you need to exclude any specific reserve. But in bank, there are some reserves made for a particular purpose. Say retirement benefit reserve. So when people retire, then they are given retirement benefits. So or say provident fund. So those again reserve, but it's made for a purpose. So you can't absorb your loss by using that reserve because that is meant to pay EPF or provident fund for employees. That reserve you can't use it to absorb losses. So that kind of a specific reserve we need to exclude. But any other general reserve is considered as your set 1 capital. Then unpublished current year profit. Now, say if you are preparing your accounts for June, right? You are preparing this capital return for June. Then you can take your current year profit. So far, there's two quarters. So first quarter and second quarter is over. So that whatever the profit for the 2 quarters, you can take into your set 1 capital. But interim accounts are not audited now, because auditor will do only at the year end. But now it's only halfway through, so it's an interim account, which is not audited. Therefore, if you want to include this profit in your capital, you need to get an audited certification. So you need to do an interim audit and get your profit certified from the auditor. Then you can include in your capital. But say for the 6 month you end up with a loss. So no need of auditor certification. It's a loss. You deduct the entire loss immediately, right? So if you want to include a profit, you need to get audit certification. If it's a loss, immediately deduct. Then, so these are the capital component comes under the equity capital, Tier 1 or Set 1. Then there are some adjustments. We need to adjust some of the kind of intangible capital out of this capital, because those the objective is the capital should be capable of absorbing losses. Now you have capital, but it's not capable of absorbing loss. What is the point? Again, you can't absorb losses. So therefore, whatever the intangible kind of capital need to be taken out. So there are some adjustments we need to do. So goodwill, you need to take out from your capital. So it's a capital deduction, right? You compute all these, add all these components, then you deduct these components from that. So goodwill, you need to deduct from your set 1. And if you have any other intangible, maybe software, right? So there are a lot of software considered as intangible assets. You need to take out from your capital. Revaluation reserve. Revaluation losses. So you've done a revaluation of your head office building, but it's a loss. Unlikely in Sri Lanka, properties never end up with a loss, right? So if there's a loss, you need to deduct that. Deferred tax, if there's any deferred tax, you need to deduct. Shortfall in specific provision, and in relation to NPL loans, non-performing loan, there are provisions, right? But you made a provision which is not adequate. There's a shortfall. Then all that shortfall we need to adjust through the capital. Then investment or purchase of own shares. So you can't purchase your own share. Banks are not permitted. And if it's permitted under exceptional circumstances, only very rare, but there were cases where the central bank permitted to buy own shares. So in that case, you need to deduct that from your capital. It's not your capital. It's your own. You can't buy your own shares. So it's not part of your capital for capital adequacy purpose. You need to take out. Then reciprocal holding of capital in financial institution, right? So maybe one bank may invest in equity capital of another bank, or one bank may invest in equity capital of another finance company, right? Financial institution, any financial institution. If there's a cross-holding, right? And that bank may invest in your equity, you may invest in their equity. So those are practical example. So in that those are called cross-holding. So both the companies have ownership in both companies, right? You have ownership in other company, that company have ownership in your company, your bank, right? So those are cross-holding. Those need to be adjusted, right? Only thing is, it's a little bit complicated adjustments. So I don't know how it's effective. to explain in a video conference thing, right? But I have given an example here, reciprocal cross-holding. So a bank invested in another bank 10 million in set 1 capital, 5 million in additional tier 1 capital, 5 million in tier 2 capital. And that bank have invested in this bank, say bank A and B, for example. Bank A invested in bank E, bank B, set 1 10 million, AT1 5 million, T2 5 million. Bank B invested in bank A, set 1 5 million, AT1 2 million, tier 2 capital 8 million. So then we need to compute bank's A investment in bank B. So they invested 10 plus 5 plus 5, 20. Then we need to compute bank's B investment in bank A. So bank B invested 5 million, 2 million, 8 million. So that is 15 million in bank A. Now we need to deduct the reciprocal holding, the lower amount, based on the corresponding deduction approach. Now corresponding deduction approach means this bank invested in 3 different types of instrument. So set 1 is one type of instrument, set AT1 is another type of capital instrument, T2 is another type of capital instrument. Then we need to work out a pro rata basis for this, right? So that is the corresponding deduction approach. So accordingly, the bank A, the computing bank, need to deduct 15 million investment in bank B, but on a pro rata basis. Now they invested 10 million in set 1 out of 20 million, right? So 15 million again pro rata. This is 81 instrument. So you deduct 81, 5 over 20, and tier 2, 5 over 20. So we need to work out a pro rata basis to distribute this 15 million investment into different capital component. So set 1 out of 15 million, you deduct only half of it. And under AT1, you deduct 1/4. And tier 2, you deduct 1/4. So 1/4, 1/4 plus half equal to 1. So 15 million is deducted in 3 places. So that is how we do this adjustment. Then there are some other adjustments which I am not intended to go because it's very complicated. Without using the board, it's difficult. But try to understand. It's easy to understand. I put it in a way that anybody can read and understand this computation. You can do this computation for your own knowledge, right? So all these computations are complicated and I'm not going into the detail. But remember, there are some adjustments to set 1 capital, right? So after computing your set 1 capital, we need to do the adjustments whatever listed here. Then you will get the eligible set 1 capital, right? So that is one component in your capital computation. The second component is the tier 1 capital or additional tier 1 capital. In addition to set 1, there are some other kind of capital which is similar to equity but not equity. For example, preference shares. So preference shares are similar to equity but not equity. So equity is computed under set 1 and all other similar instrument computed under AT1 or additional tier 1, right? But there are conditions if you want to include in your AT1 capital. So those instruments, now I'll take only one example. We'll keep preference shares as example for AT1, right? So if it's a preference shares, it should be fully paid in cash, right? So there's no part paid. If you have part paid instrument, it's not part of your capital. Should be issued and fully paid. And it should be a perpetual instrument. Perpetual means there's no maturity, right? So that's why we say preference shares similar to equity because there's no maturity. But it's not the same because interest is fixed. For equity, dividend is not fixed. Okay. But the condition, it should have fully paid and it should be a perpetual instrument. There's no maturity period. And that instrument should be subordinated to depositors and tier 2 holders. So that means in case of a bank failure, in case of a liquidation, first we will pay the depositors, then creditors, then tier 2 holder, then only AT1 holder will be paid. So whatever the claim at the time of liquidation will be paid only after depositors, creditors, and T2 holders. But there are some perpetual preference shares. They have priority in claim. So that is special kind. If they are paid before the T2 holder, tier 2 holder, that kind of a preference share is not considered for capital adequacy. We need to take out. So those are removed from your capital computation. Those instruments, if they satisfy this condition, then only you can include. Right? The third condition is the preference share should not be secured or covered by the issuer. So when companies issue some preference share, they say this is secured by my head office building. So this is secured by this branch building, or it's guaranteed by my director. So there are so many ways you can issue. But if a bank want to take preference shares into AT1 capital, it should not have any kind of these securities or guarantees. It's an unsecured instrument, right? And bank are given the option to call back. Now, say a bank issued a preference shares in 2015. Now the bank think that I don't need this capital because now the interest rate is low. In 2015, they could have issued at 15% interest rate. But now, since the current market rate is low, they could have issued today the same instrument at 10%. So why should the bank pay 5% to that investor? Since it's a perpetual, right? So then we permitted the bank to call that instrument back. They can call back. But only after 5 years. Before 5 years, they can't call back and with central bank approval. But again, if it's called back, they need to immediately issue new preference shares for the same value, right, at the current market rate. So there no way the capital can go down. They can call back, but they have to immediately issue a new issue. They have to make a new issue for the same value, for the same amount. Otherwise, your capital will go down. Once you call back, your capital go down, but that is not permitted. You can call back, but you have to replenish with the same amount of capital, same quality capital immediately, right? So that is condition. Bank has the full discretion to cancel dividend. So if a bank wants, you should be able to cancel dividend. And dividend should be paid out of distributable item. So if you have profit this year, you can pay dividend, otherwise no. Capital instruments shall not have a credit sensitive dividend feature. This is another condition where when you issue a debenture or a preference share, you say, okay, if the interest rate increased, it's linked to certain benchmark, say AWPLR or whatever the rate, right? So those are credit sensitive features. So whenever rate change, the dividend or the interest is increased. So those things are not permitted. If that is that feature is available in that instrument, that's not part of your capital. So it need to be excluded. So loss absorption through conversion or write-off. at the point of non-viability. Now, this is very important. This is the Basel III special. We know owners' equity shares can absorb loss. But debentures, I said previously, debenture is a debt you need to pay back. Right? Now, that is right until Basel III came in. Now, even somebody invested in debenture of a bank, if the bank run into trouble, that investor is not paid back. You can write off the debenture. You say, okay, according to Basel framework, we are not going to pay back your debenture. We are writing off. Right? Or you may convert the debenture into equity. So that equity will be there, never paid until the company is liquidated or the bank is liquidated. Equity will be there. So you are not going to pay back the investor. So when people make investment in banks, debenture, they are very concerned, right? Because under Basel III, bank can say that we are not going to pay back your investment. So it's written out, right? So you have to have that feature in your instrument. Otherwise, it's not your tier 1 capital, not your tier 2 capital, right? And banking group, again, directly you can't purchase. And own investment you can't purchase. And the reciprocal cross-holding, the same adjustment we discussed earlier, you need to do for T1 also, AT1 also. Then we'll see what are the tier 2 components. Tier 2 components. So tier 2 are basically debentures. All right. The common example is debenture. Again, it should be issued and fully paid. But this is not perpetual. There's a maturity for debenture, generally 5 years, or anything over 5 years can be. Right? So it's not perpetual. There is a fixed maturity period. Again, it should be subordinated to claims of depositors and general creditor, neither secured or covered by the issuer or guaranteed by the issuer. And if it's a debenture, it should be listed in the stock exchange, Colombo Stock Exchange. For 81, the listing is not required, but for 80 or tier 2 or debenture, the listing in the stock market is important. So otherwise, it's not part of your capital. Or otherwise, you need to take special permission from the central bank to go for a private placement. You're not going to list in the stock market, you go for a private placement. That central bank will permit in an extraordinary situation. Not everybody will get that. Right? Then tier 2 is limited to 50% of set 1. So this is where the ceiling come in. So bank cannot issue more and more debentures because we need equity capital more. Therefore, debentures are kept at 50% of set 1. Right? And the minimum maturity should be 5 years. So 5 years the minimum, and beyond that, any number of years you can issue. Then you need to amortize the debenture over 5 years. So every year you need to amortize or discount by 20%. So after 5 years, you have already created a fund, right? So amortization fund is there. And again, this also may be callable. You can call back with central bank approval after 5 years. But again, you need to replenish with the same amount of capital, tier 2 capital. And this instrument also will have a loss absorption clause, either by write-off or by conversion. And then the own investment, the same criteria are there. You can't invest in your own shares, own debentures. That is, you can't permit. Then the second component of tier 2 is revaluation gain. So I said in Sri Lanka, every year go and you revalue your building, the prices are increasing. So whenever the prices of building increases, there's a revaluation gain. So that you can include under tier 2 capital, but there are some conditions. So the first condition is every year you can't do the revaluation. So it should be at least once in 3 years with central bank approval. Then the revaluation gain is limited to 50% of the difference between cost and fair value, right? Then the new thing under IFRS, because you know under IFRS there is no specific provision or general provision, no more there. So now what we have is stage one. Under IFRS, loans are classified into three stages: stage one, stage two, and stage three. Stage three is basically NPL. It's similar to NPL, right? Stage one and two, most of them are performing loan. So performing loan, under the previous method, there's a general provision, right? And that general provision is permitted to compute or take in under the tier 2 capital. So you can take your general provision as tier 2 capital. But now we change the methodology. How? Whatever the impairment made on stage 1 loans, you can take 100%. And whatever the impairment made on stage 2 loan, you can take 50% of it as general provision. So this is similar to general provision, but it's a different method. Again, there are some deductions to 81. We already discussed that, right? So that's how we compute the capital. So our capital will have a set 1 component, common equity tier 1 component, and there are some adjustments we need to do that. Then we have additional tier 1 component. Again, there are some adjustments. Then we have tier 2 component. Again, there are some adjustments. So after adjusting all those for set 1, AT1, and T2, we'll get the eligible capital for Basel III capital adequacy computation. Okay. So any clarification? Any clarification? At least you are listening, no? What is PONV stand for? PONV stand for point of non-viability. Point of non-viability. Now that is the point where the central bank decide this bank is no more viable. So bank is going to fail now. So that's the point, right? So it's determined by the central bank. Central bank says, okay, after this point, there's no chance of viability. So you're going to fail. So at that point, all that AT1 and tier 2 will be converted, right, to absorb losses. So if a bank reached to that point of non-viability, you can convert your debenture and whatever the preference shares and absorb loss. You can do that. Thank you very much. Any other question? Okay, shall I move on? So this is how we compute capital, right? For the Basel III capital computation. So now we found out what is our eligible capital component. The next step is we need to compute what is the risk-weighted assets of your balance sheet, right? So we'll compute the risk-weighted assets for default risk, for market risk, and for operational risk. So these are the pillar 1 risk. It's called pillar 1 risk. I said Basel 3 or Basel 2 framework had 3 pillars. So risk weight is basically based on Basel 2. There's no Basel 3 risk weight. So Basel 3 is on capital that now we have completed. And for risk weight, we follow the Basel 2 approach where there are 3 approaches. The first one is pillar 1 approach. It says how capital need to be computed, or risk-weighted assets need to be computed for default risk, market risk, and operational risk. So we'll start with credit risk or default risk. Right? Computing risk-weighted assets for credit risk. Now, when I say credit risk, now this is the general term used in Basel document. But again, remember when I say credit risk, there are two types of risk. One is default risk, other one is concentration risk, credit concentration risk. So both together only it becomes a credit risk, right? So under pillar 1, will risk weight only for default risk. Even though we use the term credit risk, it's actually a default risk. But in pillar 2, under ICAP, I think you might heard what is ICAP, right? So under ICAP, pillar 2 will compute capital for concentration risk. So concentration is not covered under pillar 1. So pillar 1 covers only the default risk, but generally known as credit risk. Right? These are the pillars. Pillar 1, you need to compute capital for credit, market, and operational risk. For pillar 2 under ICAP, you need to cover all other risk. So some risk not covered under pillar 1, you need to cover under pillar 2. Example, liquidity risk, reputation risk, compliance risk, model risk, right? And legal risk. There are so many risks. And there are some risk which is not fully covered under pillar 1. The example is credit risk. I said even though we say credit risk here, we are going to cover only default risk. We are not covering concentration risk. Therefore, concentration risk is covered under pillar 2, under ICAP. Similarly, I said market risk, so which include interest rate risk, right? So market risk include interest rate risk, equity risk, and exchange rate risk. Right? Again, the interest rate, again, there could be interest rate in the banking book or interest rate in the trading book. Now, what we are going to cover here is the interest rate in the trading book. Only the trading book we are going to cover. Therefore, the interest rate in banking book is covered under pillar 2. Right? So pillar 2 covers whatever not covered under pillar 1 and whatever partly covered under pillar 1. So when you finish pillar 1 and 2, all the risk in your bank are covered. Okay. And for this particular session is on pillar 1. So we are not going to compute capital under pillar 2. So it's a ICAP, it's a very huge topic. So you have to have a separate lesson for that. So today what we are going to see is we are going to compare our capital against the pillar 1 risk, the default risk, market risk, and operational risk. Okay. So in order to compute pillar 1 risk, Basel have given different approaches. So credit risk, we use standardized approach, foundation IRB approach, and advanced IRB approach. Now in Sri Lanka, we are using standardized approach, right? All our banks use the standardized approach to compute credit risk, capital charge for credit risk. Then with regard to operational risk, again, there are 3 approaches: advanced measurement approach, standardized approach, and basic indicator approach. Now in Sri Lanka, most of our banks follow the basic indicator approach, right? So majority of banks follow the basic indicator approach, but there are few banks, they follow standardized approach. Okay. So they follow a standardized approach. With regard to market risk, again, there are 2 models. It can be an internal model computation or standardized approach. So in Sri Lanka, again, we follow only the standardized approach. Okay. So we'll start with the credit risk. So we are following the standardized approach. So under standardized approach, the majority of the computation depends on ratings, right? So it's largely supported by credit ratings, and central bank has defined who are the acceptable rating agencies. So these are the acceptable rating agency. So you can use only the ratings given by these agencies. No other rating agencies rating can be used. Okay. So these are the approved or acceptable rating agency for capital computation. Then we compute the default risk for all claims. So that include placement with banks, investments. Again, investment is held to maturity investment, not trading investment. Held to maturity investment, loans and advances, or any other credit exposure. Right? So in your balance sheet, all the items are risk weighted. Right? Then in a balance sheet, there are two components, on balance sheet and off balance sheet. Right? With regard to on balance sheet, the risk weight is given by the regulator. Now, you look at this table, right? Now, this risk weight is defined by the regulator based on the Basel Accord. And bank, what you all need to do is you need to identify the rating bucket of a claim. Say, for example, loan. So you'll have given a loan to a triple rated company, triple A rated company, right? So then this is the rating bucket and the applicable risk weight is 0. If it's A plus to A minus, risk weight is 20. Likewise, you need to identify the rating of the claim and you have to put it under the relevant bucket. Then this is automated. The risk weighted amount is automated. So you just enter your exposure here, loan amount here. The risk weight is fixed by the regulator. It will automatically compute your risk-weighted assets. Right? And off-balance sheet, the second table, off-balance sheets are not exposure. It's not happened still. So it's kind of a memorandum. It may crystallize or may not crystallize. Okay. So off-balance sheet, what we do is you have to report your principal amount here. Right? So you have a bank guarantee for 5 million, you report here 5 million. Then this 5 million will be converted using a credit conversion factor. Right? Hope you are looking at this table. Right? Can you see the movement in mouse? Can you all see the movement in the mouse pointer? You all can see, no? Okay, so credit conversion factor is given by the regulator. You have to convert your exposure using the credit conversion factor. I'll call it CCF. Then you will get an answer called credit equivalent of balance sheet. So this credit equivalent you report here on the top table, on the on balance sheet table. The rest is automated. Okay. Then there are some conditions to choose the rating. Right. So first one is consistency. Now here, if we are using, say, for example, Fitch rating for regulatory purpose, and even for your internal purpose, you have to use Fitch rating. And if you are using Moody's for internal purpose, for regulatory purpose, you need to use Moody's. So you can't use two different rating agencies for internal reporting and regulatory reporting. That is not permitted. Then cherry picking, no cherry picking. Now cherry picking is where you, for some time you select Fitch, some other time you select Moody's, right? For the same loan. So last time Fitch rating was higher, you selected Fitch rating, last quarter reporting. Now this quarter reporting, rating changed. Now the Moody's rating is better. So now you can't select Moody, right? So that is cherry picking. So every time you take whatever the best rating. So ratings are generally changed. So when they change, you select the rating agency which give the best rating. So that is cherry picking, which is not permitted. Then group rating. Now, say if you take a group of company, say for example, John Keel's Holdings, so it's a group of company. There are a large number of subsidiaries or associates, right? Some of the subsidiaries are rated. This is only example. I don't know what the John Keel's subsidiary are rated or not. I don't know, but only an example, right? We assume that some of the subsidiary of Haley's are rated, some are not rated. You have given a loan to a company in Haley's group which is not rated, right? So not unrated loan, you need to risk weight at 100%. Okay, so in order to avoid that 100%, some bank what they do is they try to use the group rating. So Haley's rating is AAA. They use the AAA for the unrated company. So that is not permitted. So group rating you can't use for unrated entity in the same group. That you can't do. Then again, we know different rating agency give different kind of notations. Right? These are different notation, not all look like similar. So therefore, we need to map the rating given by this is the capital adequacy rating, right? This is the capital ratio, the rating scale we use for capital adequacy. Therefore, we need to map the rating to match the regulatory rating. Okay. Then again, ratings are given for short term and long term. Right? So in the case of a short term, there are some conditions we need to comply with. So short term rating are generally given for banks and corporates where the exposure is short term. Like they issue a 1 year debenture or 5 year debenture is a short term rating, right? And ratings, short term rating are given for specific issue. So you are going to issue a debenture, you get a rating for that debenture. And that may be different from your corporate rating. So corporate is the issuer and debenture is the issue. So short-term ratings are given for instrument, not for corporates, right? And then when there is a short-term rating, it gets a 50% risk weight, right? You have some rated short-term facility, some unrated short-term facility, right? Not to the one customer, and it's your total portfolio. So in your bank, you have 50 short-term facilities and 25 is rated, 25 is not rated, right? Different companies. Now, out of that rated, one company was 50% risk weight. So in that case, you need to risk weight all the unrated short-term at 100%. Right? If you find one short-term with 50% risk weight, you need to rate or risk weight all your unrated at 100%. Similarly, if there's a one facility which is risk weighted at 150%, you need to rate or risk weight all your unrated claim at 150%. So that is the important thing. There's one short-term facility which gets a 50% risk weight. All your short-term have to risk weight at 100%. And one short-term gets 150 risk weight. Then all your short-term and long-term need to risk weighted at 150%. Then again, banks are used to use only the solicited rating. Right? Solicited rating means the company go to a rating agency and ask for a rating. So that is solicited. So we need to use only that rating. And the issuer I already explained. Issuer means the entity, issue means the instrument. Then again, mapping for short-term rating. Now, multiple rating. Say one company will take Abans Limited, rated by Fitch and rated by Moody's. One company rated by two different agencies and two different ratings. Say Fitch rated AAA, Moody's rated AA plus. Two different rating agency, but same company. Now, as a bank, what rating you should use? So you have to use the lowest rating. Therefore, so lowest rating will have a highest risk weight. So you need to use the lowest rating. Therefore, you need to give the high risk weight. Say Avance Limited again, rated by three companies, Fitch, S&P and Moody's. Same company rated by three agencies, three different rating. So in that case, what you select? You select the second highest rating. So in this example, the second highest is AA plus. Right? You are not taking the best, you are not taking the lowest, but you take the second highest. If it's a two company, you need to say take the lowest rating. Right? So this is an example I have given. And the placement with the bank ABC, amount is 459. Rating agency 1 rated BBB, risk weight is 50. Rating agency 2 rated BB plus, risk weight is 100. So which risk weight you will use, or which rating you will use? You have to use the lowest rating, that means the highest risk weight. So you have to risk weight at 100%. Risk weight at 100%. Right? Then there are some specific rules. We need to risk weight only performing loans. Exposure of some other class of assets are risk weighted based on other approaches. Right? So say in your balance sheet, you might have different items. So rated loans, unrated, loan to rated company, loans to unrated companies, right? Treasury bills, treasury bonds, loan to government, loan to state-owned enterprises. There are different items. So some of them are risk-weighted based on external rating, right? Some of them are risk-weighted using external rating, and some of them are risk-weighted based on different approach that we will see later. So we'll start with whatever the exposure risk-weighted based on external rating. Okay. Exposure to foreign sovereigns and central banks. So your bank have given a loan to, say, a foreign country or to a foreign central bank. So then you need to see what is the sovereign rating of that country. And you have to apply the risk weight according to the rating. Right? And a loan given to Central Bank of Sri Lanka or the government of Sri Lanka is risk weighted, not based on rating. So it's a different approach. Okay, we'll tell that later. So if your bank have given a loan to a foreign country or a foreign central bank, we need to see what is the sovereign rating of that country and apply whatever the applicable risk weight. Then exposure to local and foreign public sector enterprises like corporations, provincial authority, local government authority, like right, board. There are a lot of SOEs, state-owned enterprises, or we'll call public sector enterprises. So whether it's a local SOE or a foreign SOE, we need to get that rating. If it's not rated, then you'll put 100%. So all unrated are 100%, right? So if it's rated, you can use the rating and apply a low risk weight. Then if your bank given loan to multilateral development bank, then again, we need to understand that multilateral bank or development bank, some are special multilateral development bank like IMF, World Bank, Asian Development Bank, IFC, International Financial Corporations. So those are special banks, multilateral development bank. And any loan given to them, but only thing is we never give loan to them, but we take loan from them. So that's the difference, right? But if in any chance we have given, your bank have given loan to say IMF or ADB, that is risk weighted based on a different approach, right? It's basically zero. But now if you can see here in this table, the last claim on official entities and MDBs. Now, Bank for International Settlement, IMF, European Central Bank, European Union, and ADB, IFC, the risk weight is zero. And all other multilateral development banks, there are large number of multilateral development banks in globally working in. So if you have given loan to those kind, then it will be based on the risk weight or the rating, external rating. So I don't think any bank in Sri Lanka would have lent to those institutions. Therefore, it's not an important thing. But remember, there are some important multilateral development bank risk weighted at zero, others depending on external rating. Then claim on banks. So one bank may have placement with another bank. It can be a rupee placement or a foreign currency placement, right? So in such a situation, again, the risk weight is based on external rating. But for the bank exposure, depending on the time period, we have divided into different categories. So one is rupee exposure less than 3 months. Second one, foreign currency exposure less than 3 months. Third one, rupee or foreign currency more than 3 months. So depending on the time period, you need to put into different buckets. But again, the risk weight depends on the external rating, right? And have given some example or case studies here for your knowledge. So a bank has made a significant investment in equity in a finance company. So it's again investment in other financial institution, where the external rating is A+. So the finance company is rated with A+. The amount is 10 million. But the investment is more than 1% of CET1 capital of the bank. Investment has been classified as trading investment. How do you risk weight this instrument? Again, I think we need to forget this more than 1%, because I told you in the capital computation there are some complicated adjustments, right? So in cross holdings and investment in financial institutions. So I think we need to skip this because I'm not in a position to explain with an example, right? I'll just explain what is the treatment for this case study. So a significant investment in equity means more than 10% investment, right? So more than 10% investment is categorized as a significant. And for this finance company, the rating agency's rating is A+, therefore risk weight should be 50%. And it is a trading investment. So I said trading investments are not risk weighted for default risk, not risk weighted for credit risk, because it goes to market risk computation, right? And investment is more than 1% of CET1 capital. Again, this is relating to that capital deduction. We'll forget about that. And investment in a financial institution. How do you risk weight? This should not be risk weighted because it goes to capital deduction, right? It goes to capital deduction because it's more than, it's a significant investment having more than 1% of CET1 capital of the bank. Therefore, it goes to capital deduction. So you are not required to risk weight this. So the point is you need to identify each of your claim, whether this is a risk weight for default risk weight for market risk, or it's a capital deduction that we need to identify, right? So that's why I have given this example. Then again, there are some others risk weighted based on ratings, claims on financial institution regulated by central bank. So these are not significant investment, non-significant, insignificant investment, less than 10%. Then it comes to risk weight. Okay. But again, if it could be a financial institution, but not regulated by central bank, then the risk weights are different, right? And if it's regulated by central bank, then again the risk weights are different. You can see the rating buckets are different. Now this is AAA to AA minus, and below also AAA to AA. The second one A to BBB minus, but this is A to A minus. So these buckets are different. So therefore the risk weight also different. So first we need to segregate whether this is a financial institution regulated by the central bank or not by the central bank. That identification we need to make. Now these are some examples. I have given this name of banks or financial institution only for example purpose. It's not the real situation. But these examples are mistakes done by banks. So this is taken from banks on-site examination reports. And I didn't mention from which bank this has taken, therefore no issue, right? I didn't mention the bank. But this particular, we'll take the first example. These are real examples, right? This particular bank granted a loan to Sanasa Development Bank, right? Amount up to 851 million. And they categorized under claims on financial institution regulated by central bank. Is it correct? Is that correct? So that particular bank has given a loan to Sanasa Development Bank, but they are risk weighted under institution regulated by central banks. Is that correct? Anyone? Hasalaka, what is your answer? Hasalaka? Yes, professionals are not talking. Why is that? In the morning, I had a class for school leavers, but they were very communicative, very interactive. Either they spoke or either they sent message. These professionals, no message, no talking. Why is that? Hmm? I don't know whether I'm online. So even my line got disconnected. I don't know. I just keep on talking. Am I online with you all? Hello. Yes, Hasalaka said yes. So then what is the answer for that? Yeah, Taruka also said yes. Okay, thanks, Taruka. So can you tell me? You just send me message. So if you are shy to talk on, right, you can send messages. So a bank, that particular bank, given a loan to Sanasa Development Bank, and that bank has classified as exposure to institution regulated by central bank. Is that correct? But that is not correct because for banks there is a separate risk weighting method. I told, no? So before coming into financial institution, we started with bank. Depending on the time period, you need to risk weight on a different approach. So banks, if it's a if it's a bank, you can't, even though it is regulated by the central bank, you can't put it under institution regulated by central bank. It should be reported under claims on bank. Second example, a bank given a loans and advances to Dunamis Capital PLC and Global Trust Financial Service Limited and categorized under claim on financial institution regulated by CBSL. Whether this is correct? Again, no, because even though these are finance companies, and these companies are not regulated by central bank. So as people work in bank, you should know what are the institutions regulated by central bank and what are the institutions not regulated by central bank. Otherwise, what will happen? You know what happened during that murder of the three-wheel association member? It's not a financial institution regulated by the central bank, but everybody thought it was regulated by central bank, right? So we should know what are the entities regulated by central bank and what are the entities not regulated by central bank. The third example, loans and advances to Richard Peary's finance company amounting to this much, categorized under financial claim on financial institution not regulated by central bank. Again, the same mistake. This person, whoever preparing this return, this capital computation, they don't know Richard Peary's is a regulated entity. They don't know that, right? So we should know what are the appropriate category. This facility should be risk weighted under which category? You can't put a bank in under regulated by central bank. You can't put a finance company not regulated by central bank under regulated by central bank, right? So those are important things. Those are practical mistakes done by banks. So with regard to corporates, again, it depends on rating. So if the corporate is rated, you can use the rating for risk rate. Otherwise, if it's unrated, then again 100%. Then again, this another mistake. A bank given a loan to Abans Finance and Cambridge Finance, but they put it under corporates. These are corporate, but again, these are finance companies regulated by central bank. So therefore, it should come under finance institution regulated by central bank. If you are putting under corporate, again, it's a mistake. Now, the important thing is the ratings and the rating buckets are different. Claim to claim, it's different. So therefore, by putting in a wrong place, you may understate your capital computation or capital adequacy, or you may overstate your capital adequacy, right? So that's why it's important to identify the correct placing, correct place to report your claims. So yeah, this is the summary table. I said the ratings are different, right? The bucket to bucket, depending on the claim. See, this, if it's a short-term loan to bank, up to B minus, it's 20%. But if the bank, if a short-term loan to loans in foreign currency, 20% is given only up to AA minus. So these buckets and the ratings are different. Okay. So I think those are the exposure where we can use the rating, external rating to risk weight. Now we'll move to exposure which are risk weighted not based on rating. So no more rating for this. So these kind of exposures are risk weighted based on a different mechanism. Okay, now so far what I have done is I explained what are the balance sheet item risk weighted based on external rating, right? So there are some other items in our balance sheet which are risk weighted not based on external rating. So one of the such item is loans to central government and the central bank. So if a bank has given a loan facility to the government of Sri Lanka or to the central bank, then that kind of loans, if there is a rupee loan, will be risk weighted at 0%. But say you have given a loan or exposure, you have an exposure to the government in foreign currency. Example, for bank may give loans in foreign currency to the government, or they may invest in SLDB. SLDB is a foreign currency instrument of the government. Similarly, international sovereign bond (ISBs), again a foreign currency instrument of the government. Now, if you have any claim, any investment on such thing, then that foreign currency claim need to be risk weighted at 20%, right? If it's a central rupee claim, 0%. If it's a foreign currency claim, then it has to risk weight at 20%, because our central bank or our government cannot print dollars, right? So we may default in foreign currency lending, or the government. The government may default on foreign currency borrowings. Okay. So in the case of rupee, the government and the central bank can print money and give the whatever they due. But the government or central bank, we can't print dollars. Therefore, any foreign currency exposure to the government or to the central bank need to be risk weighted at 20%. And I said some of the multilateral development banks are risk weighted at 0, and that is this IMF, European Central Bank, European Union, and there are IFCs, ADB. There are many that kind of institution. If you are granted any facility or any exposure, it's risk weighted at 0%. This is another example. A bank granted a foreign currency loan of USD 25 million to CPC, which is fully guaranteed by the government. How do you risk weight? I said exposure to government, but it doesn't mean that indirect exposures. Right? Now here, the bank has given a loan to CPC, not to the government, but that loan is guaranteed by the government. So how we are going to treat that? And in this capital computation, there's a separate item called CRM, credit risk mitigant, right? CRM. So we'll discuss in a while, in few minutes. So CRM means if a loan is collateralized by certain collateral, say government guarantee, then you can set off. So it's no need to risk weight that. Okay, no need to risk weight that. So you put it under CRM and you keep 0 amount of capital. Okay, can we put, because this is guaranteed by a government loan given to CPC, so can we put it under CRM? Only thing is, this loan is in dollars. So I said, if it's a rupee claim, then you can risk it at 0%. But this is a foreign currency claim, again, not a direct claim to the central government. Now it is a kind of an indirect. If CPC default, you will ask the government to pay. So that is the guarantee, right? So it's an indirect exposure. So how are we going to treat that? In fact, the central bank regulation is silent on this. Now we say if you give a loan to the central government in foreign currency, you keep 20% capital, or you risk weight 20%. But the direction doesn't say that if the central government give a guarantee for a loan given to, in this example, CPC, again it's a foreign currency loan, there's no specification mentioned in the regulation. So a bank, if they want, they can say, okay, direction is silent. I'm not going to keep 20% capital. I will put this under CRM. So as a regulator, central bank need to say, okay, they need to accept that. Okay. But again, on the spirit of the regulation, because we can't cover, I mean, the central bank can't cover every scenario in a regulation, because regulations are issued on principle based. We consider only the principle and we issue the regulation. Now the principle is, since the central government can't print dollars, they can't print dollar, they need to keep 20% capital. So the same principle apply even for an indirect exposure. But even though it is not mentioned, the bank cannot put zero risk weight for this. They have to keep 20% capital for this, right? So this kind of indirect thing, if it's in foreign currency relating to a government exposure, then you have to risk weight at 20%, right? Then qualifying retail claim, if you have given loans to SME or individuals, right? So that is called retail claim. And there are some qualification criteria. If that loan satisfy that clarification or qualification criteria, you can give a lower risk weight, right? So if it's a qualified retail claim secured by property, then the risk weight is 60%. Or any other qualifying retail claim, 75%. Or any other qualifying loan to individual, because individual also considered as a retail, therefore retail and SME, therefore that also 75%. But any SME do not qualify with the criteria, so that is unqualified retail claim, then it will be risk weighted at 100%. And these are the qualifying criteria. Anyway, I'm not going to explain that. Then claims secured by gold. Now we know all our banks give pawning, right? So they lent on pawning, take gold jewelries and give money, pawning business. Okay. So those are called claims secured by gold, because you have a collateral in the form of gold jewelry. Now for that, the regulation says LTV ratio less than 70% or equal, the risk weight is 0. So LTV means you need to compute the market value of the gold jewelry and what is the percentage of market value you have given as advance, right? Say if the market value is 100, you have given 70 rupees loan, then your LTV is 70%. So 70% or less, the risk weight is 0. The LTV ratio over 70% but less than 100% facilities, risk weight is 20. The LTV is equal or more than 100%, risk weight is 100. Okay. Again, one of the bank, right? This is again an actual case taken from examination finding. The bank, they give gold-backed facilities, pawning facilities, right? And the amount of loan is 500,000. The market value is 625. Okay. So the LTV is 80%. How do you risk weight this? At 0% or 20%? Any answer? Any answer? So you have given a pawning facility with a LTV of 80%. Now regulation says LTV less than 70%, 0% risk weight. 70 to 100, 20%. So what should be the risk weight? The LTV is 80%. 20 or 100? 20. Ama, you said 20. Yomali also says 20. Right? So
Yeah,
can you explain me why it's Nimali also saying 20%? Can you explain why? Because it's straightforward, right? So LTV is more than 70%. Now what you all said is correct, right? But the bank, what they did was, they are more smarter than you and me. They said, okay, up to 70%, that is up to rupees 473,500, we will give 0%. And the balance 62,500, we will give 20%. Okay. So bankers are like this. They are, try to be more smarter than the regulator. Okay. So can we accept this? Can we accept? So can we accept? They said, okay, up to 70%, the regulation says less than 70%, zero risk weight. Therefore, up to 70%, that is 473,500, will risk weight at zero, the balance at 20%. They can't do that because that is one exposure, one loan. Now, for example, we'll take loan. So bank managers, they approve loans, right? And the bank manager and the credit officers are given something called delegation of authority. So yeah, they have given limit. Up to this limit, they can approve. So after that, they have to go to the board. Now say a manager's limit is 100,000. So one loan is for 150,000. Can you tell that, okay, up to 100,000 I will approve and balance 50,000 board can approve? Can you tell that to the, can that bank or the officer tell the same thing to the board? I will approve up to 100,000 and you approve the balance 50,000. They can't because that is one exposure. Therefore, the total exposure exceeds 70%, then it needs to be risk weighted at 20%. Okay, so this is how bank think. Then claims secured by residential property. So this is property but used for residential purpose. If it qualify, again some qualifying criteria given. If it qualify, the risk rate is 50, otherwise 100. Again, there could be some other property, but those are not residential, those are commercial property. So if the loan is given for a commercial property, right, you take the commercial property as a mortgage and give loan, that kind of loan risk weight is 100. So only in the case of a residential property, a lower risk weight of 50 is given. Okay, this is another example. The bank granted a residential mortgage for 10 million, fully secured by secondary mortgage for the same bank. LTV ratio is 70%. The property was valued by the panel valuer in 2010 facility is performing currently. How do you risk weight this? Now, this is a residential mortgage. Therefore, you can use 50%, but it's not a primary mortgage. This is a secondary mortgage. If I go back to the qualifying criteria, it says fully secured by primary mortgage. The second condition is, if other than primary mortgage, it should be from the same bank for residential purpose, right? So even though this is secondary mortgage and it is with the same bank, if the primary mortgage is with bank A and the bank B is going to give a secondary mortgage loan, then it's not 50% risk weight, it should be 100%. But in this case, the first primary and secondary mortgage are with the same bank. Therefore, this can be risk weighted at 50%. So valuation is not relevant for this. Valuation is relevant if the facility is NPL, non-performing loan, then valuation is applied. So performing loan valuation is not relevant. And LTV is 70%. So therefore, you can risk weight at 50%. Then if it's a non-performing loan, it depends, risk weight depends on the amount of provision you made, specific provision, not general provision, because general provision are made for performing loan. For NPL, for non-performing loan, specific provisions are relevant. Now, if the specific provision is more than 20%, the risk weight is 50. The provision is less than 20%, the risk weight is 100. Right? But this is if the loan is secured by property, residential property. Say you have an NPL loan which is not secured by residential property. It's a normal loan. It's not secured by property. So again, we need to check the amount of provision. If the provision is more than 20%, you risk weight at 100. Less than 20%, risk weight at 150. So residential property, if it's in the NPL, then we give a lower risk weight, right? But any other property risk weight is high, 150 also given. So NPA, again, there are conditions, we'll skip that. Then high risk category. So there are some exposure identified as high risk. Say investment in venture capital, the risk weight is 150. And significant investment in capital of financial institution. I told this at the time of explaining the capital computation. There is a capital deduction on cross-holding in financial institution. So if it's a significant investment, and I said significant is more than 10%, in that case, there are part of the exposure will be deducted from the capital. The balance part will be risk weighted at 250. So if you go back to that capital computation and check the example given by me, you can understand. So out of the significant investment, part of it we deducted from the capital, a balance we risk weighted at 250, right? And cash risk weighted at 0%. And any other instrument in the balance sheet like fixed assets or other assets, receivables, all that risk weighted at 100%. Then that is how we risk weight on balance sheet. So some of the on balance sheet are risk weighted at by using the credit rating, and some of the on balance sheet are risk weighted at a risk weight given by the regulator. Then off balance sheet, I said first we need to convert this amount into a credit equivalent by using credit conversion factor, CCF, right? Then we take this amount to the on balance sheet. So these are the CCF. For direct credit substitute like general guarantees, standby LCs, this conversion factor is 100. In the case of a transaction-related contingency, like site LCs, performance bond, bid bond, those are transaction-related. CCF is 50. And guarantees, shipping guarantee, that kind self-liquidating contingency. Because once the ship come to Sri Lanka, the guarantee automatically get expired. So shipping guarantee is given only during the shipment. So once the ship reached the port and the container is unloaded, the guarantee automatically get cancelled. So that kind of exposure, conversion factor is 20. And some repo and reverse repo agreements, housing loan sold with recourse, and there are some exposure. So that kind of an exposure are converted at 100%. Right. So in Sri Lanka, I don't think bank will have a asset sale, but in foreign countries, they sell their loan portfolio, they sell their assets, but the credit risk will remain with the bank. Now, the good example what I can give you is the recent refinance. Now, the COVID affected business, central bank introduced a refinance scheme in March, right? So under that, bank give the loan to borrower, central bank will refinance it, but if the borrower fail to pay back the loan, the bank need to pay the loan. So still the credit risk remain with the bank, right? Credit risk is not transferred. But there are some other arrangement where credit risk also transferred. Say, for example, can't remember the name we use for that. A leasing company do that. They sell. They totally sell the portfolio, and whoever purchasing, they recover, and whatever they can recover, they recover it. The balance, they have to bear the loss. So in that case, the credit risk is taken out of the bank. Okay. Still can't remember the word we use for that. But this is where you sold your portfolio, but still the risk is with the bank. Credit risk is with the bank. So in that case, the conversion factor is 100%. Then underwriting arrangements, commitment with original maturity up to 1 year, commitment with maturity over 1 year. So there are different type of off-balance sheet exposure. So each exposure given CCF, conversion factor, by the regulator. So regulator, based on the Basel Accord, we have given conversion factor for each kind of off-balance sheet item. So again, this is a foreign exchange contract. This is the CCF. Interest rate contract. This is the CCF. So each and every off-balance sheet item, regulator have mentioned what is the conversion factor. So simply you have to multiply your exposure by this conversion factor, then take to your on-balance sheet item, and again that on-balance sheet item will be risk weighted. Right? So off-balance sheet, there are two kind of conversion. First you convert with CCF, then you risk weight with risk weights. Then CRM. I told you a few slides back, credit risk mitigant is a special kind of treatment where exposure is guaranteed or collateralized, right? So CRM basically reduce your credit risk. Say in that example, bank given a loan to CPC, but that loan is guaranteed by the government. So if the CPC fail to pay the loan, government will pay the loan. So bank's credit risk is mitigated, but it will lead to some other risk. Now, real example, Sri Lanka, I can give. We know government contractors, right? So they build road and bridges and government buildings. So they take loan from bank based on government guarantee, right? Now, we have a big number of government guarantors who defaulted. Sorry, government contractors, they defaulted. Okay, when the bank go to the government, go to treasury and ask for the claim, guarantee claim, the government says we don't have money, right? So you mitigate your credit risk, but it leads to some other risk. So the government still have a large amount of pending payment for banks on behalf of government contractors, right? So CRM it's only mitigate your credit risk, but it will lead to a different risk. It could be a liquidity risk or an operational risk or legal risk. Now in this case, it's a legal risk. Can we put a case against the government in the court? We can't. Even you put, you will never win, right? So your credit risk is out, but you are exposed to now legal risk. Okay. So remember, CRM only look after credit risk, and it creates some other risk. So under CRM, there are some methodology. One is collateralized transaction, right? So you have given a loan to CPC backed by government guarantee. So it's a collateralized transaction. For that, you don't need to risk weight anything. So it's a zero risk weight. Or it can be a guaranteed transaction. Sorry, I made a mistake. A collateralized means there is a property or acceptable security given. Say FD backed loan. So bank have given a loan based on FD. So the FD is the collateral, that is the security. The customer failed to pay the loan, what the bank do? You take out the FD and recover the loan. So that is collateralized transaction. Second one, guaranteed transaction. That is the example I explained. You give a loan to CPC, which is backed by the government guarantee. So that kind of a transaction, guaranteed. Other one is on balance sheet netting. This is where you have an asset in your balance sheet for a customer, and for the same customer, you have a liability, right? You have a deposit account which is not under lien. Now this collateralized is under lien. So it is kept as security. And this case, that deposit is not a security. So people can have deposit account and loan account, right? But that deposit is not under lien, not under security. But still, bank can net it off. You can set off your loan with whatever the balances in the deposit account. And if you have for a same customer deposit and a loan, then that loan is not risk weighted because you can net it off with the deposit. Or bank can buy a credit derivative. So I know most of the bank, when they give personal loan, they buy a insurance. It's called loan protection. Yeah, I think loan protection or CDS, credit default swap, right? So when you buy an insurance for a personal loan, if the person died, or even for housing loan, bank get loan protection. So if the borrower failed to pay, you go to the insurance company and claim. So your credit risk is mitigated. Therefore, no need to keep capital. Okay. So this is the CRM technique. I think that's enough on that. Now, collateralized transaction, even you can't take all the collateral. Now, if a loan is backed by property mortgage, it is not collateralized, right? So the regulator has given what are the eligible collateral. It should be a cash and FDs or treasury bills bonds or EPF balances, right? Or debt securities with minimum 20% risk rate, and unrated debt security issued by a bank, or shares listed in S&P 20. Again, there's a haircut. So subject to these are the only eligible collateral for a CRM technique under collateralized transaction. Or it could be any other collateral, property mortgage, residential property, commercial property, personal guarantee, or any other collateral, machinery, vehicle are not considered for CRM. All those loans are risk weighted. If that loan is collateralized only by this collateral, then the treatment is different. Then on balance sheet netting, I already mentioned you. You have a loan and a deposit for the same customer. So if they fail to pay, you can set it off. Therefore, not necessary to risk weight. Then guarantee, and if the guarantee is given by the central government or the central bank, then risk weight is 0. If the guarantee is given by sovereign entities and public sector enterprise, the risk weight is 20. And if the guarantee is given by the Sri Lanka Export Credit Insurance, then the risk weight is 50. And any other guarantee given by any other person or entity is not eligible for CRM. Okay, so that is how we compute credit risk or capital charge for credit risk under Basel II. Okay, any doubt? So we'll move to market risk. Again, I said we follow, there are 3 approaches, but we follow only the standardized approach. Or rather 2 approaches are there, but we follow only the standardized approach. And again, this is very complex, and it's very difficult to understand. I don't know how I can explain you without face-to-face interaction and without using the board. But what I do is I'll just explain you the concept, right? I have given example, and if you need, you can go through and understand. Okay. So when we say market risk, that covers interest rate risk in the trading book, not in the banking book. Banking book goes to ICAP under Pillar 2. Here we consider only interest rate risk in the trading book, equity risk again in the trading book, and foreign exchange position, right? So these 3 together, we compute the market risk, capital charge for market risk. Okay, so we take interest related instrument, equity, and foreign exchange. Foreign exchange also include gold, right? So we'll see how the interest rate risk is computed. Now for computing capital charge for interest rate risk in the trading book, we need to compute a general risk charge and a specific risk charge. Okay. General risk charge means you have a portfolio of investments, right? Say we'll take, for easiest example is treasury bill. So interest rate related instrument. Treasury bills are generally in the trading book because it's less than 1 year maturity. So it's in the trading book. Now you have a treasury bill portfolio in your bank. For that, you need to keep a general risk. And for individual treasury bill, you need to keep a specific risk charge. Okay. So general risk capture the loss arising from changes in market rate on portfolio basis. So this is for the total portfolio. So how do we compute that? So we'll go to this example. Now say this is the treasury bill we have, treasury bill portfolio. Okay. Then, and we'll take only one, number 1. So the maturity date is, I think, sorry, this is, I made this presentation sometimes back. So I didn't have time to change all these things. But you say this is 2021. So it's maturing in January 2021. Or we'll take this example as it is, only an example, right? So the maturity date is 20th January 2019. Face value is 100,000. And first we need to compute the date maturity, right? Now today, 31st December 2018. So today, 31st December 2018, and the instrument will mature on 20th January 2019. So how many days remaining for this maturity? We have 20 more days. So in 20 days, this treasury bill will mature. Okay. So then we need to compute what is the current market rate for this bill. Okay. So, and we know, the market rates are published by the central bank. So in this case, so the market rate is 9.45. Okay. So we are computing, the computation date is 31st December and the maturity date is 20 January 2019, face value 100,000 and date to maturity is 20 and the current market is 9.45. So then first we need to compute the market value of this treasury bill. So how do we compute the market value? We take the face value, we take the interest rate, and we take the remaining maturity. So by using these three, the face value, remaining maturity, and the current rate, we can compute the market value, right? Now we have to add a change, assume change to the yield. Now this table is given by Basel, right? Say if you have a say in our example, the date to maturity is 20. So 20 means less than 1 month. Therefore, the assumed change should be 2%. Now, the time to maturity is 1 year or 1.9 year, then it's 1.8. So similarly, different maturities, the change is different. But in our example, the time to maturity is 20 days. So therefore, it's less than 1 month bucket. The change is 2%. Now, you add that 2% to current market rate. So 9 plus 9.45 plus 2% is 11.45. Then again, we have to compute the market value at the new rate. Now, in this case, we take this 100,000, 20-day remaining maturity, and the new market rate of 11.45. So initially we computed at 9.45. Now we compute at 11.45. And you get a new market value. Okay. So the general risk charge is the difference between new market value and the original market value, right? So here it's 99,376 and the original market value is 99,484. So the drop in market value, right? The reduction in market value, or the difference between the new value and the old value is your risk charge. Okay. So for every instrument, you need to compute the general risk charge. And this is your portfolio risk charge. And with regard to specific risk, since it's a treasury bill, we assume that government will not default, therefore specific risk is 0. Okay. But if it's a foreign government or foreign central bank, now in the case of government of Sri Lanka and the central bank of Sri Lanka, specific risk is 0, according to our previous example. But if it's a foreign bank or a foreign central bank, the specific risk could depend on the rating, the sovereign rating of that country, right? Now, if you take this example, this is a US government, your UK government treasury, right? And the rest of it same. So you compute the market value at the original rate, then you compute the market value at the new rate after adding that change. So you get the general risk charge. Then with regard to specific risk, you need to get the rating. So in this case, the rating is A+. Therefore, since it's A+, it will be either 2.5, 1% or 1.6%, depending on the maturity, right? So in this case, it's 1% because maturity is 1.1 year, 1.1 year. So 1.1 year means residual maturity greater than 6 months and less than 24 months. So our instrument will fall into that bucket, therefore 1% specific charge is made. Okay. So that's how we compute the general charge and specific risk charge for interest rate instrument. Then equity instrument. So this is basically shares in the stock market. So bank invest in stock market. So again, we take only the trading book, and that include all the instrument similar to stock. Equities, unit trust, bonus issue, right issue, everything is considered. The general risk, again, equity will have two risk charge, general risk charge and specific risk charge. So general risk charge required is the required capital ratio. Now I said for some bank minimum ratio is 12.5, some bank it's 14%. So you simply multiply your whatever the portfolio by 12.5 or 14% depending on your bank. So that is the general risk charge. Specific risk charge depends on the share price index. Now say the particular equity is listed in S&P SL 20 index, then you multiply by tier 1 capital ratio, tier 1. And if it is listed in any other index, multiply by the total capital ratio. So again, I have given an example. So these are the companies where the bank has invested, and these are the invested amount. They have invested 800,000 in equity. So general risk charge is simple, right? So can't see this because there's a notification. Okay. So this particular bank minimum capital is 12.5%. It could be 14 for some other bank. So you just simply multiply 800,000 into 12.5. So that is you need to keep 100,000. This is general risk charge. For specific risk charge, you need to find out whether this stock listed in S&P or all share price index. So some are in this example, some are listed in S&P, some are in all share price index. Now if it's S&P, you multiply by your tier 1 capital. For any bank, tier 1 capital is same. There's no change. Whether it's a DSIB or non-DSIB, tier 1 is same. So you multiply by 8.5. And if it's all share price index, you multiply by your total capital. This could be 12.5 or 14, depending on the bank. So this is your specific risk charge. Then with regard to foreign exchange risk and gold risk, what we do is we compute the net open position on individual currency. So net open position is the difference between foreign currency assets and foreign currency liabilities, right? So the difference between foreign currency assets and foreign currency liabilities is the net open position. We need to compute for each and every currency. So one bank may deal in 15 currency. Then you need to have 15 column. Right? One bank may be dealing only in 5 currencies, so they will have 5 columns. So for each currency, you need to compute net open position. So you deduct foreign currency assets minus liabilities, right? For some currency, you may end up with a long position. So long position means you have more foreign currency assets than foreign currency liabilities. Sometime bank might have short position where foreign currency liabilities are more than foreign currency assets. So then we'll put that in a bracket. Now in this case, so this bank have a long position in USD but short position in GBP, right? Similarly, other currencies. So after computing the NOP for each and every currency, you need to add all the long positions separately, right? All the plus separately, all the minuses separately, right? So if you add plus, we get 250,000. 150, 100, 250,000. If you add all the minuses, you get 450,000. 450. Okay. So now we take whichever is high. If the total of pluses are high, we take that. The total of minuses are high, we take that. Right? So in this example, minuses are more than plus point numbers. So our capital charge is 450,000. Right? Again, I said when we compute foreign exchange, we compute gold position also. Gold also computed similarly. You take gold position, it could be a plus or minus, and regardless of the sign, you take that position, whichever is higher. Right? So your total FX and gold position is 450 FX position and 50 gold position, so that is 500,000. Okay, and the capital charge you multiply by your minimum capital ratio. It could be 12.5 or 14%. Okay. So this is the summary of all the computation. Leisurely you can go through that with the computation table given in this presentation. So each instrument I have given example. So this table is made of that. So now finally we move to operational risk. How to compute our capital charge for operational risk. I said there are three methods: basic indicator, standardized and advanced measurement. So we are following actually basic indicator and the standardized approach. The standardized approach again divided into two. One is the standardized approach and the other one is alternative standardized approach. So our bank can use basic indicator approach, standardized approach, or the alternative standardized approach. Right? So in order to compute the capital charge, first we need to find out the gross income for last 12 quarters. So I mean 3 years, right? So last 12 quarters, we need to find out the gross income. So first year, second year, and third year. 3 years, 12 quarters. Okay. Then, in the case of a basic indicator approach, to get the average income, average gross income, that is the total of 3-year gross income divided by 3. So we get the total and multiply by a alpha factor. Alpha factor is fixed by the regulator. At the moment, it is 15%. So you get the 3-year average income, multiply by 15%. So that is your capital charge for operational risk. In order to get the risk-weighted asset, we need to multiply the capital charge by reciprocal of the required minimum. So if your capital ratio is 14%, reciprocal is 1 over 14. If your capital is 12.5, the reciprocal is 1 over 12.5. So that is either 7.8 to 7.1% or 8%. So you multiply this, whatever the 15% charge, by 7.1 or 8, depending on your bank. So that is straightforward, very simple. Right? So then we'll go to standardized approach. Now standardized approach, bank can move, right? So if a bank think that whatever the capital charge under basic indicator is more, they can move to a higher standard. so that the capital charge will be less. Now, I said in my example, under Basel 1, the capital charge is more compared to Basel 2, right? Because Basel 2 is more advanced, more rational. Similarly, this 15%, it's a magical number, right? Nobody know what is that 15%. So it's not rational, it's based on just an example. The standardized is more rational based, so your capital charge is low, so you can move, right? But a bank need to get the central bank approval in order to migrate, right? So once you have moved to advanced approach, you can't come back. Now after some time, you can't say, no, this is difficult for me, I want to go back to the basic indicator. You can't say that. Once you move to advanced method, you have to stick to that. But if the central bank is not satisfied, now we central bank think that okay, this bank is not capable of because this standardized or advanced approach need lot of models, right? Models, and it's lot of work we need to involve. So if the regulator think that okay, at that time we gave them permission, but now considering their capabilities and systems and all, this bank is not capable. So then the regulator can tell the bank, okay, you are not capable, you go back to basic indicator approach. That is possible, right? But a bank on their own, they can't come back. So it's only possible when the central bank asks them to do so, right? So under the standardized or alternative standardized, what happens is the business line of a bank is divided into 8 groups, right? So under basic indicator, you get the total gross income. But under standardized, your gross income are divided into business line. So how much of income you get from corporate finance? How much of income you get from trading? How much of income you get from asset management? How much of income you get from agency functions? And how much from retail banking and how much from corporate banking? So Basel has given 8 categories and 8 different beta factors. Now in the previous case, it's only 15%, right? So now it's more rational. So if the risk is high, your beta factor is high. Your risk is low, beta factor is low, right? So it ranges from 12% to 18%, 12, 15, and 18, 3 different beta factors. So bank should have the system capability to map all your income, right? All your income to this business line. So previously you take the total. Where it come, it doesn't matter. You take the total. But under the standardized approach, you need to identify which income come from which business line. So you need to map all your income line to business line, right? The rest of is same. So these are the business line. So you can go through later. So each and every category I have given what are the business related business, right? So you can go through that later. And the rest of the computation is same. Okay. So here again, you compute your income based on this business line for 3 years or 12 quarters. Okay. So you compute your business income for these business lines for 3 years and take the average, right? So that's all. You take the average, you divide it by 3. And in order to get the risk-weighted assets, you multiply the capital charge by the reciprocal minimum capital. So the rest of the method is same as basic indicator. Only thing here you need to identify your business line. That is very difficult. It's not easy. And each and every income you derive from which business line. So that mapping process is very important and it's difficult. Under the alternative standardized approach, similar to this, but only thing, instead of taking this retail banking income and commercial banking income, what we do is we take the loan outstanding of retail banking. So how much, what is the retail loans? What is the amount of commercial loans or corporate loans? How much of retail loans we have, how much of corporate loans we have. So that is the only difference. So for the first 6 business line, 1 to 6, you compute your gross income divided by 3. Then for retail business, you don't take the income from retail business, but you take the loans, average loan from business, multiply by a M factor, M again fixed by the Basel, that is 0.035. So you take the average loan, 3-year average loan, multiply by M 0.035, multiply by beta factors. For retail, what is the beta factor? 12. And for commercial banking, 15. You do the same thing, right? So this is retail and this is corporate. So again, you take the 3 average loans and loan balances for corporate loan balance, multiply by M factor, which is 0.035, and again multiply by beta factor, which is 15 for corporate loans. And in order to get the risk rate, you multiply the capital charge by the reciprocal of minimum capital. And this is a workout example given for all 3 methods. Basic indicator, if you use the basic indicator, you come up with a capital charge of 2.9 million or 2.9 billion, right? 2,902 million. But if you use the standardized approach, your capital charge is less, 2.5 billion. And if you use the alternative method, alternative standardized, your capital charge is 1.7 billion. This is a real example of a bank. So that bank can reduce the capital charge from 2.9 billion to 1.7 billion. So this is a big capital saving, right? Now, if you have capital, there is no return. Capital has 0 return. You just keep that. You can't lend, you can't invest. So by using an advanced approach, by using a rational approach, you can reduce your capital charge, similar to risk weight under Basel I and Basel II. You reduce your capital charge. Okay. I think that's all. So that's how we compute capital charge for capital adequacy framework under Basel III. So you need to compute what is your eligible capital. Then you need to compute what is your risk of capital charge on credit risk, capital charge on market risk, and capital charge on operational risk. Then simply you can use this formula, capital divided by risk-weighted assets into 100, so that you can get the capital adequacy ratio. Now for a small bank, it should be, that answer should be more than 12.5, and for a DSIB, it should be more than 14%. That's it. Any clarification? Any clarification? This is the first time doing an online lecture without, proper interaction. Okay, if there's no clarification, we can wind up the class. Thank you.